With December right around the corner, despite this absolute dumpster fire of a macro environment, are we poised for a Santa Claus bear market rally? Or is Papa Powell going to Grinch us and steal Christmas? Hello, I'm Crypto Casey and welcome to another episode of Crypto This Week. Every Sunday we explore the latest global news stories affecting the crypto markets, as well as the ever-changing macroeconomic environment of the world at large. Be sure to check out our sponsors, Ledger, Unstoppable Domains, and Sorare. Get your crypto off of exchanges and onto cold storage hardware wallets with Ledger. And this weekend, Ledger is running Black Friday specials, so redeem their 10% off Black Friday deal by using the link below and discount code BLACKFRIDAY10. Secure your unique human-readable crypto wallet domain name like Casey.wallet with Unstoppable Domains, who is running a Cyber Monday special we will go over together, and also more on Sorare in a bit. Awesome, let's hit Crypto This Week. In response to the FTX liquidity and bankruptcy fiasco, their whistleblower Binance publishes official Merkle Tree-based proof of reserves. 2 weeks after its initial pledge for Merkle Tree-backed proof of funds, Binance releases its official response to liquidity transparency. And I'm going to have to go with Kraken CEO Jesse Powell on this one. I'm sorry, but no. This is not proof of reserves. This is either ignorance or intentional misrepresentation. The Merkle tree is just hand-wavy BS without an auditor to make sure you didn't include accounts with negative balances. The statement of assets is pointless without liabilities. So a lot of these centralized crypto exchanges and similar entities are sharing their assets without sharing their liabilities, which is basically like if a company shared a bank statement showing us they have $10 billion cash without sharing that they owe $100 billion in loans and debt. It doesn't matter if it looks like you have a lot of assets to the tune of $10 billion when your debt obligations vastly outweigh them by a factor of 10. And something important to note, which we explore in great detail in my trilogy series breaking down the structure of the traditional financial system, the current card house structure of crypto, and basically how and why the current contagion occurred, is due to the rampant rehypothecation of crypto throughout the markets. This means there are more debt claims to Bitcoin and other crypto than actual Bitcoin and crypto in circulation. This means that for every Bitcoin a person may see on their crypto exchange app, multiple people are looking at the same exact Bitcoin on their exchange app in their account. So basically, if everyone who thinks they own the crypto they see on the exchange in their accounts went to withdraw it to their own self-custody wallet like Ledger devices, there wouldn't be enough Bitcoin or crypto to go around. The more Bitcoin that leaves exchanges, the more likely we could experience a short squeeze scenario with Bitcoin. That could, on a brighter note, drive the price up substantially, while on a dire note, deleverage a GBSI, or global systemically important bank, causing a global systemically catastrophic meltdown in both the crypto and traditional financial markets. We have yet to see the full effects of the FTX contagion, and as we discussed last week, it has certainly spilled into the traditional financial markets. To what extent? Only time will tell. What we do know is banks aren't even trusting one another, as evident in the US Treasury liquidity crisis. The US Treasury market is extremely important to global financial stability, and the Fed, the market's largest buyer of US Treasury securities, isn't buying at the same pace as before. And in this scenario, usually big banks step in as Treasury market makers. But due to market volatility and increasing counterparty risk, big domestic banks and even international buyers aren't buying. Either way, as it has been over the past several months, the amount of Bitcoin on exchanges continues to decrease at a rapid pace. Bitcoin exchanges see 180,000 Bitcoin supply decrease amid Mt. Gox Bitcoin sales. Bitcoin exchanges may have just seen the largest exodus of user funds ever, data suggests. With FTX contagion still in the air, exchange users have been busy withdrawing funds to non-custodial wallets. As Cointelegraph reported, $3 billion worth of cryptocurrency left major platforms in the immediate aftermath of FTX imploding. And also this week, Bitcoin worth $1.5 billion withdrawn from Coinbase in 48 hours. 50,000 Bitcoin were withdrawn from Coinbase on November 24th and 25th, marking the third largest withdrawal from the exchange. All the while, crypto's new Fed and altruistic or sinister white knight, let me know what you think in the comments below, Binance deploys $1 billion to keep crypto industry afloat after FTX collapse. It may increase that amount to $2 billion at a point in time in the future if the need arises, the company added. Something is strange here. Sure, helping the crypto card house stay intact helps the crypto market, and as the largest crypto exchange in the world, is also self-serving of Binance. But I'm bearish about the whole thing. Binance and Tether are the two 800-pound gorillas in the crypto space. And if either one of them goes bust, the other one will go bust, along with everything else. And that is still a real possibility. It turns out FTX was buying all of these insolvent entities not to help crypto survive, but rather keep Ponziing their way from going insolvent themselves. Crazy times. Speaking of FTX, why aren't you in jail already? Internet erupts after Sam Bankman-Fried confirms participating in New York Times deal pool. In 2008, Bernie Madoff was arrested within 24 hours of his fraud being revealed. In 2022, Sam Bankman-Fried will be attending the New York Times Deal Book Summit after his fraud was revealed. How is this even possible? Could it have something to do with this? Just in, Sam Bankman-Fried and FTX executives donated $70 million to US politicians for midterm elections, weeks before filing for bankruptcy, Bloomberg reports. Justice has a price. That price is freedom, or a sizable political donation to lawmakers in exchange for your freedom, I guess. And having politicians in your pocket comes with even more perks. FTX stake in US bank raises concerns about banking loopholes. The chairman of the Rural Bank, Jean-Charles Le Pen, also happens to be the chairman of Deltec Bank, which has Tether and Alameda both on its client list. FTX's ownership in US bank Moonstone is seen as a move to bypass the requirement of owning a banking license in the US, which according to many, is quite a complex task. With the amount of political connections Sam Bankman-Fried had, I would not be surprised either if he just got that license for no reason. Apart from FTX's stake in a US bank, what drew more attention from the crypto community is the connection between the Rural Bank's parent company, FBH, and another crypto entity, Tether, the largest issuer of a stablecoin in the crypto market currently. The banking connection between Tether and FTX Alameda became a concern for many in the crypto community, as Tether itself has long been under scrutiny for its reserve audits. Tether didn't respond to Cointelegraph's request for comments as of publication time. Yikes. Yes, we still need to allow time for more bad insolvent players to get shaken out because dominoes that fell earlier this year are still echoing throughout the markets. The most recent FTX domino could take several more months, as Warren Buffett would say, for the tide to go out and discover who's been swimming naked. Scary. So let's take a quick moment to explore a more light and fun blockchain project gaining adoption whose success is independent from the traditional and crypto markets. Sorare is a global fantasy sports entertainment platform that aims to create a new experience for fans by combining the traditional collectible sports card aspect of fandom with the more modern fantasy team building aspect of fandom, and with even more creative nuances in between. Based on our skills and knowledge of sports and players, we can win cool prizes, including awesome digital collectibles like officially licensed player cards as NFTs, which we can use or sell for cash. Sorare is not an investment or gambling product, rather a skills-based game across multiple sports leagues like the MLB, NBA, and football, as in soccer. And right now, in our Crypto Fam private league, which you can join now by using the link in the description area below, we are all competing against each other in the Football World Championship. So if you haven't yet, be sure to check out my full video guide on Sorare and how to play in this free, fun World Cup together by clicking on the link above. Sweet. Back to some more bearish news that may hinder crypto adoption in the short term. Lawmakers urge Fidelity to drop Bitcoin retirement plan after FTX crash. 3 senators reiterate warnings to the investment giant, citing problems like charismatic wunderkinds. And following suit, New York Attorney General urges Congress to prohibit retirement investments in crypto assets. Meanwhile, across the pond, Bitcoin and Ether needn't follow financial rules, Belgian regulator says. Officials hope to fend off a rising number of questions about how crypto should be regulated and when they should be treated as securities. The rules, which largely mirror those set out in a July consultation, say that transferable instruments with an issuer are likely to constitute a security. That means they must produce an honest prospectus of information for potential investors and must apply an EU law known as MiFID, which requires financiers to be clear and to avoid conflicts of interest. But cryptocurrencies like Bitcoin don't count, as they don't have an issuer. Bullish. Back across the pond, more bullish news this week as a Harvard research paper urges governments and central banks to add Bitcoin to reserves to hedge sanction risks. The research paper based the idea of central bank risk hedging with Bitcoin on the fact that many central banks, and in particular those facing a higher risk of US sanctions, in recent years have increased the share of their reserves made up by gold, a traditional central bank reserve asset. According to the author, adding a Bitcoin allocation in addition to gold would further increase the resilience against sanctions for these countries. This is especially true in cases where the country struggles to acquire enough physical gold, the author argued, and the timeliness of this paper couldn't be more spot on. China's gold stockpiling is dollar warning sign. Beijing is quietly dumping dollars for gold as greenback strength looks increasingly illusionary. Chinese leader Xi Jinping's position hasn't changed so much as other governments are catching on that trust is waning in the global reserve currency, and an alternative to the dollar is badly needed. Is gold on a comeback? Not surprisingly, central banks that once hoarded dollars are buying gold at the fastest clip on record. In the July to September quarter, central banks more than quadrupled gold purchases from a year earlier, adding nearly a net 400 tons of already sizable stockpiles. And dollar hegemony as the world's reserve currency continues to decline, especially on the petrodollar front, as we've seen over the past several months from the Russian-Ukrainian war, and it continues as the Fed continues to increase interest rates. This week, Ghana plans to buy oil with gold instead of dollars. The move is aimed at tackling dwindling forex reserves amidst rising inflation and a weakening local currency. With dollar dominance in decline and BRICS nations coming together against the dollar, will Papa Powell continue raising rates at the next FOMC or Federal Open Market Committee meeting December 14th, drenching us and stealing our historical Christmas Santa Claus rally? Fed officials see smaller rate hikes coming soon, minutes show. Federal Reserve officials expect to switch to smaller interest rate increases soon, according to minutes from the November meeting released Wednesday. So what does this actually mean? Well, Savage Finn Henrik gives us a nice translation in these tweets, where he, LOLs, at some participants observed that there had been an increase in the risk that the cumulative policy restraint would exceed what was required to bring inflation back to 2%. This implies rate cuts coming in 2023. When you give 100 hawkish speeches about how serious you are about further tightening, but then drop dovish minutes about how scared you are of doing so, you might just be sending a waffling mixed signal. The Fed, in essence, already knows it's overdoing it, leading to recession, but of course they won't put it in their economic projections, which remain positive. That makes it an inherent dishonest organization which relies on jawboning to try to manipulate market expectations. At the end of the day, like we've been discussing on the channel, this market downturn heavily correlates with the Fed's decision to start rate hikes and decrease the amount of money entering circulation. And the next bull cycle will heavily correlate with a Fed pivot. And here's an important chart we should keep in mind as investors that shows us how markets historically react when a Fed pivot occurs. We can see that each time a pivot occurs, we see a 36% drop, 48% drop, 27% drop, 51%, 58%, and the latest one a few years back was a 35% drop. And what does that tell us? It tells us that historically we see the market bottom when the Fed pivots. Does that mean it's going to play out like that this time around? Not necessarily. A lot more people are in the markets now, we are all privy to similar information, so we very well could bypass a bottom when a pivot occurs because we're all waiting with cash on the sidelines for it. That's why my random wild guess is when a pivot occurs, sure, it could be the bottom or it could cause a bottom we've all been waiting for, but the swing back to the upside may be a lot faster and exponential than we think. That's why DCAing or dollar cost averaging into positions during the bear market is a superior strategy for most, and if you've been watching our bear market series, why it's so important to be focusing on increasing our income and income streams so we can take advantage of this likely once-in-a-generation opportunity. In the series, we discuss how important it is to start working on our own personal brand or businesses to monetize in the space in the future. One of the first steps we can take to invest in our own personal brands and businesses is by securing a Web3 domain to use in the crypto space. If you haven't secured a domain name for yourself, your brand, your business idea, or similar, time is of the essence. So be sure to check out Unstoppable Domains to secure yours today. You can use your NFT domains as a universal username across applications and websites. You can use it as a website URL others can access. You can use it as a payment address for wallets instead of the long, cumbersome public addresses we currently use. Basically, these NFT domains allow us to replace cryptocurrency addresses with human-readable names. So when you send cryptocurrency, all you need to know is the recipient's NFT domain, like Casey.wallet, and you can send them Bitcoin or Ethereum or any other cryptocurrency just with one domain. So be sure to use the link in the description area below to access Unstoppable Domains' correct and official site to take advantage of their Cyber Monday deal on Monday, November 28th at 9 a.m. Eastern, where for 24 hours only you can buy a Web3 domain and get one of equal or lesser value for free. There are no limits to how many domains you can buy, and the sales include premium domains. So scroll down to check it out. Awesome. Well, that was Crypto This Week with me, Crypto Casey. If you enjoyed the episode, please make sure to like the video, subscribe to the channel, and click the bell notification to stay up to date on all of the latest videos. So, do you think Binance is solvent and will save the crypto markets? Or are they just further delaying a certain collapse? Will we experience a short squeeze with the Bitcoin price at some point? Will SBF ever see the inside of a jail cell? Let me know in the comments below. Be safe out there.